Should you still be watching crypto prices in 2026? Or are you staring at the wrong screen while the real shift happens somewhere else? Because right now, millions of people wake up, grab their phone, open TradingView, check Bitcoin, check Ethereum, refresh the altcoins, panic, zoom into the 15-minute chart, and repeat. But what if I told you the biggest money in this cycle won't be made by people watching price? It'll be made by people watching something else, and most won't even notice it. Today, we're breaking down the 2026 shift, why price is the distraction, what you should actually be tracking, and how this one mindset change could completely alter your results in crypto. Let's get into it. 1. Price is the last thing to move. Let's start with a hard truth. Price is the final reaction, not the cause, not the signal, the reaction. Think about it. When Bitcoin pumps 20% in a week, do you think that's random? Or do you think positioning, liquidity, and capital flows were building quietly before the move? By the time you see a green candle on Bitcoin, the smart money has already positioned. By the time Ethereum breaks resistance, capital rotation already started days or weeks earlier. Price is the scoreboard. It's not the playbook. And yet, most retail traders stare at the scoreboard all day long. It's like watching a football match by only looking at the score and ignoring what's happening on the field. You don't see momentum building. You don't see fatigue. You don't see strategic shifts. You just see numbers change. And that's exactly how most people approach crypto. They refresh, they react, they feel emotional highs and lows, but they don't see the underlying mechanics. In 2026, this matters more than ever because the market structure has changed. Institutional players now dominate Bitcoin liquidity. ETFs absorb supply. Large funds rotate capital between sectors like AI tokens, real-world asset tokenization, DeFi, and Layer 2s. And these shifts start quietly, before price confirms anything. If you're only watching candles, you're late. 2. Liquidity is the real signal. If price is the reaction, liquidity is the cause. Liquidity is oxygen for markets. When liquidity expands, risk assets move. When liquidity tightens, they struggle. It's that simple. Now ask yourself, how many crypto investors track global liquidity? How many track bond yields? How many track central bank policy? Very few. Yet these are the variables that drive risk-on and risk-off cycles. When the Federal Reserve loosens financial conditions, Bitcoin tends to breathe. When yields spike aggressively, liquidity drains from speculative assets. This isn't theory. Look back at 2020. Massive liquidity injection. Bitcoin exploded. Look at 2022. Liquidity contraction. Everything collapsed. The 2026 shift isn't about hype. It's about capital flows. Stablecoin supply expanding? That's liquidity entering crypto. US dollar weakening? Risk assets tend to rise. ETF inflows accelerating? Structural demand increasing. These signals move before price does. Imagine watching stablecoin market cap grow steadily for weeks, and Bitcoin hasn't moved yet. That's pressure building under the surface. Most people won't notice. They'll wait for the breakout, but the breakout was obvious if you were watching liquidity. Stop watching the candle. Start watching the fuel. 3. Attention is the early indicator. There's something even more powerful than liquidity. Attention. Crypto is narrative-driven, always has been. In 2017, it was ICOs. In 2020, it was DeFi. In 2021, it was NFTs and Metaverse. In 2024 and 2025, it was AI tokens, real-world asset tokenization, Layer 2 ecosystems. Each cycle has a story, and stories attract capital. Before price moves massively, attention shifts, search volume spikes, Twitter engagement changes, YouTube thumbnails start repeating similar themes, VC funding flows into specific sectors, developers build in one niche more than others. That's your early warning system. When attention clusters around a theme, capital follows. You don't need to predict the exact top. You just need to see the narrative rotation early. By the time your uncle asks about a specific altcoin, you're late. By the time mainstream news headlines scream about Bitcoin at new highs, the asymmetric opportunity is already gone. In 2026, narratives will rotate faster because information moves faster. If you're only watching price, you're reacting to hype. If you're watching attention flow, you're anticipating hype. Big difference. Ask yourself, where are developers building? Where are venture funds deploying? Where is social engagement organically increasing? That's the map. Price is just the final checkpoint. 4. On-chain data reveals behavior. One of the biggest advantages crypto gives us is transparency. You can literally watch behavior on-chain. You can see accumulation. You can see long-term holders refusing to sell. You can see exchange reserves declining. You can see whales moving coins. Traditional markets don't give you that visibility. Crypto does. And yet, most people ignore it. They don't look at wallet activity. They don't track supply distribution. They don't watch miner behavior. But these are leading indicators. When long-term holders accumulate Bitcoin aggressively during sideways markets, that's conviction. When coins move off exchanges into cold storage, that's reduced sell pressure. When new wallets surge dramatically, that's adoption expanding. You don't need to obsess over every metric, but you should understand what behavior looks like under the surface. Because price can be manipulated short-term, liquidity hunts happen, stop losses get triggered, derivatives create noise. On-chain trends are slower, more structural, more honest. If you learn to interpret them, you stop reacting emotionally. You start observing behavior, and markets are nothing more than aggregated human behavior. 5. Positioning and leverage tell the story. Here's something most traders ignore. Open interest, funding rates, leverage. These numbers tell you where the crowd is leaning. If funding is extremely positive, longs are overcrowded. If open interest spikes while price stalls, that's risk building. If liquidations wipe out aggressively, that's often when reversals begin. Markets punish imbalance. In 2026, derivatives dominate crypto trading volume. Perpetual futures drive short-term volatility. You might see Bitcoin drop 5% in minutes, but was that organic selling or just leveraged traders getting liquidated? When you understand positioning, sudden moves make sense. They stop feeling random. You realize many price swings are mechanical, and when retail panics, smart money often accumulates. So instead of staring at candles, watch leverage build, watch liquidations cascade, watch funding extremes, because extremes are where opportunity hides. Now, let's step back. Why does this matter so much in 2026? Because the market is maturing, retail dominance is shrinking, institutions use algorithms, funds rotate sectors, liquidity responds to macro shifts. The easy money phase is gone. The buy anything and it 100x's environment is rare. Now you need structure, you need context, you need patience. And patience is impossible if you're glued to the 5-minute chart. Think about your own behavior. How often do you check prices per day? 10 times? 20 times? 50 times? Does it help your strategy or just trigger emotion? Because here's the uncomfortable truth. Watching price constantly makes you reactive. Reactive traders chase pumps. They sell bottoms. They overtrade. They burn capital on fees. They lose conviction during volatility. But investors who watch underlying signals, they position early, they size correctly, they hold through noise, and they scale out strategically. Same market, different mindset. Now, let me give you a scenario. Imagine Bitcoin trades sideways for 3 months. Boring, choppy, no clear direction. Most retail loses interest. Volume declines. YouTube views drop. Twitter engagement fades. But quietly, stablecoin supply increases, exchange reserves decrease, long-term holders accumulate, ETF inflows remain steady, global liquidity begins expanding. Price hasn't moved yet, but conditions are shifting. If you're only watching candles, you see nothing. If you're watching structure, you see opportunity forming. That's the shift. That's the edge. And most people won't make it because it requires patience, discipline, and stepping away from the dopamine loop. If this perspective changed how you see the market, then you're already ahead, because once you stop reacting, you start positioning, and positioning is where real wealth is built in crypto. Stay sharp, stay observant, and most importantly, watch the right things.